G'day there. Welcome to the closing bell on the 6th of August. Markets continue to attempt a bit of a rally after the mayhem we've seen over the last few months. Is it the low? This is a question everyone's asking. No one really knows. It could be the low. Markets could keep rallying to the upside from here. Interest rates are certainly falling away again. But the Fed wanted to make sure everyone knew that they aren't finished yet and not to get too ahead of themselves. I think it's all still up in the air. I think the risks are still pretty high. So as the market keeps rallying here, I think the approach is to be considering, do I have too many stocks on board? Was I scared a few months ago? And now that I'm getting a chance to get out of a few things, maybe I should be taking that option up the higher this market goes now, because the risks are still pretty high. We really don't know where inflation is going to settle. There's lots of unknowns out there, and I've seen a million bear market rallies in my time, and they carry on for longer than you think. They often go higher than you think to suck more people in. But when the music stops, it stops very quickly. Once things turn down, it can be just 2 days of very large falls as everyone in the market realizes, whoops, the bear market rally was just that, and it's time to run away again. So I just wanted to show you quickly two things. Why I think the higher this goes, the more dangerous it is. And secondly, that gold may be creating a bit of a medium-term low, and there might be an opportunity in those gold stocks. All right, so let's quickly just overview of something I have shown you in the past, but just to really want to make this point clear. The simplest thing to say, I guess, would be just on the moving averages. I use the 10-month exponential moving average and the 20-month simple moving average because that 10-month exponential moves a bit faster, and the 20-month simple is like just an average of 20 months trading, a simple average. I find it works really well in stocks on a weekly basis, daily, weekly, and monthly basis. I find that setup is pretty useful. And just looking at the S&P 500 on this monthly, if we go back and look at the crash, 2000 to 2002 sell-off and the 2008, 2009 sell-off, and we just look at these moving averages, look how good they've been for, over 20 years, this setup. And once the trend changes, I think there was a little shift there, which was a dummy, and then it turned back up there. So that's the only times these moving averages have crossed in the past 22 years. And here we are here. The moving average has crossed. So that's just, for me, a bit of a sign maybe that long-term trend is turning down. And I find that the market just really often, when the trend is turning down, and the market is always doing this, is mean reverting. It's going back to the middle to really make everyone uncomfortable. The bulls and the bears, when the market is oscillating and it's at the midpoint, that's pretty much when everyone's a bit confused. And the market constantly goes there. That's where all the volume's trading. It's like a bit of a magnet, that point of control. And so what we're seeing here is that move. We've had the initial wave down, and we're seeing a rally, which is taking it back to the midpoint. Now, the midpoint of that whole range is also where those moving averages are, both that 10-month and the 20-month. So a really important zone where the market is rallying up to now. If the resistance is around that level and things turn down, you're looking at a situation that is quite dangerous. You're looking at a situation similar to what we saw here, where it's rallied back to retest the moving averages once they turn down. And if it goes back below the low, well, look what happened there. And back in 2008, similar situation. We had the trend shift. We ended up having a 3-month rally back to retest the moving averages. if the selling pressure is there and it breaks the low, watch out. So that's why I'm just a bit wary as things move forward. Doesn't mean we're turning down now. There's no sign yet. For instance, the weekly trend has turned down. So I'm allowing this rally to continue, have even bought a few stocks, but also I've taken some longer term profits out of the market last week or this week that's just passed. I sold a few positions that we've held for a couple of years. We'd taken part profits and I was running them. One of them was in Orocoba. We bought at 280. That's up above $11. I took the final chunk of profit just because I want to raise cash levels a bit as this market rallies back to these very important technical levels after the long-term trend has turned down. So that's the major point I wanted to make about the market. I'm not saying it's going to stop right here, but this area is just very important. But if it can get through that area, there's another level up higher, up around sort of 4,500. The way I'd look at it would be just to look at that whole range. And you've seen those buy and sell zones I show you, a 75% retracement of that, is going to be up around that sort of 4,500 area. So, I mean, it could get all the way up there. And when that happens, everyone gets really bullish. And if it then turns down from there, then yeah, watch out. So no signs to run away today, but for me, it's enough seeing this for me to say, I'm going to take the opportunity to take a bit of money off the table just to see what happens over the next few weeks or month. And just quickly on gold, finishing up, we did get a confirmation of a weekly buy pivot last week. So that's a nice little sign that the short-term selling pressure has now turned up. We've got a major low here, which still could eventually give way, but it has held that level I was telling you about a while ago, around 1675. It has held there, and it's created a weekly buy pivot. So for now, we're seeing a mean reversion move. The way I'd look at this would be look at this range, which is what we've been in for the last couple of years. This is the whole correction. We've been following this range, a long time. And this midpoint, 1877, is that magnet, that point of control that I tell you about. So, from here, if we can get through that 10-week exponential without, turning back down, any weekly sell pivot from here, I'd be wary of gold because the longer term, that monthly is still negative. But while this weekly buy pivot maintained, we're seeing a bounce from a major low, it could turn into something. And first of all, I need to see it back at that point of control. There could be a lot of resistance up there. I'm not saying it's going to get straight through there, but really it needs to get through there for me to start turning bigger picture bullish on gold. For the moment, it's like a short-term thing that could end up turning into something good, but there is a lot of resistance overhead. So the first hurdle for gold is to get through this 1880 region. And then I think, above there, look, it could start looking pretty good again. So that's where this opportunity might be to start picking up a few of those beaten up gold stocks. A lot of them really have fallen a long way, especially those big ones even, things like Evolution Mining, Silver Lake Resources. There's a few of those that are pretty beaten up and could be worth having a look at. So yeah, looking interesting for a bit more upside. My target though would be to this 1880 region, and that's pretty much all I'd say from this point because it could actually turn back down from there. But that in that time you might be able to ride some of those gold stocks, take part profit, and then adjust your stop loss to a break-even point, so that if it does turn down, you don't lose any money, and maybe it will turn up and gold will take off. It's very possible from this area. All right, well, that's it for today. Be wary of the stocks getting too excited, but there could be more upside. and go hunting in the gold space. Could be a few things there. All right, cheers. I'll come back with more next week.